Over the last 12 to 18 months, something really interesting has been happening in the mental health market, and most practice owners don't realize what they're seeing yet. It's not loud yet, but it is consistent and it's forming a pattern. Now, here's the clearest way that I can put it. The mental health market isn't breaking, it's actually splitting. And the side that you're on determines how much friction you feel in your business right now and over the next few years. Now, this shift isn't theoretical anymore. You can see it in the data, the behavior, and the power dynamics within the market. So we're already seeing three strong signals. The first signal is that insurance-based practices are full, but income feels flat. And I want to slow this part down because this is what gets misunderstood a lot. Here's what we're actually seeing in practices. So calendars are full, clinicians are booked 4 to 8 weeks out, wait lists are growing. So from the outside, this looks like success, but inside the business, something doesn't quite line up. So owners still can't pay themselves meaningfully more. Raises for clinicians feel tight or stressful, and the only way to increase revenue is to push more volume, which means more sessions, more hours, or just more output. Now that is the contradiction. So when people say demand is high, yes, they're right, but demand is not the problem anymore. Leverage is the problem. So here's what that means in plain terms. So leverage is the ability to turn demand into upside. So higher margins, better clinician pay, more freedom for the owner, and insurance models don't give you that lever. With insurance, the price is fixed. You have no control over it, so you don't raise it when demand increases. So when more people want care, the system doesn't necessarily reward you for that. It just asks you for more output. So more sessions, more documentation, more admin work, and more emotional labor. And what ends up happening is it creates this very specific trap. So you can be fully booked and still financially constrained. And you can have more demand than you've ever had and still feel stuck because the model only scales by adding load, not by increasing your return. So this is why practices end up feeling busy but not actually profitable. And it's why owners will say things like, I'm maxed out, but I don't feel secure. And it's why every growth conversation eventually turns into a burnout management situation instead of actual strategy. So when a model can't translate demand into higher margins, better clinician pay, or owner freedom, that's not a motivation issue and it's not a mindset issue, it's a structural issue. The system is doing exactly what it was designed to do, and that's why this is a signal, not an anomaly. Signal number 2 is that price sensitivity is splitting the market. So this is very subtle right now, but it's extremely important because it's not just that people are paying different prices, it's that they're actually asking completely different questions. So what's happening is that there's one group of prospective clients that are asking, do you take my insurance? And then there's another group who are asking, how fast can we start? So those two questions come from very different mindsets, and the gap between them is widening. So the first group is trying to reduce costs because they're paying with insurance. They're navigating constraints. They're the ones that are comparing options. They're looking for coverage. And then the second group is trying to reduce friction because they're paying privately. They're cash payers. They care about speed. They care about fit. They care about confidence and whether this actually feels like the right solution for them specifically. Now that difference matters because it changes how the market behaves. So what we're seeing is a split. The bottom of the market is getting cheaper and louder, more price comparisons, more shopping around, more urgency around cost. And at the same time, the top of the market is getting calmer and more decisive. They're asking fewer questions, they're making faster decisions, and they're operating on less back and forth. And this is really where people misunderstand what's going on. So they assume that price sensitivity is about money. It's not. It's about perceived risk. And I've seen this time and time again. People who can afford private pay are actually less tolerant of vague messaging. So they don't want to explore options. They want to know, is this built for me? Do you understand my problem? And can you help me move forward? When that's clear, price becomes secondary. And this is why positioning suddenly matters so much. When your messaging is broad, general, or indistinct, everyone becomes price sensitive because there's no clear reason to choose you. But when your positioning is specific, outcome focused, and intentional, the right clients stop negotiating and they actually decide. So this is classic market bifurcation. So as markets mature, they don't settle in the middle, they actually split. And the models that try to sit in the middle, where they're not cheap, they're not premium, they're not clearly one thing or the other, they get crushed first. Not because they're bad, but because they're just unclear. And so that's what this signal is really telling us here. The market is no longer rewarding good enough positioning, it's rewarding clarity. Now, the third marketing signal is about marketing. And this is where a lot of people get uncomfortable because it feels personal. So I want to be very clear about what I actually mean here. So there's an old world where a practice could say, We don't market, we rely on referrals. And for a long time, that was okay because it worked. Referrals were steady, directories were a lot less crowded, and demand didn't really fluctuate as much. That world doesn't exist anymore. Here's the new reality. Referral flow is inconsistent. Psychology today is saturated, and platforms change their rules constantly. Now, none of that is because practices did something wrong. It's because the environment changed. And what this shift is revealing is something important. Models that rely on external systems for demand are fragile. So if your growth depends on referral goodwill, directory algorithms, or platform visibility that you don't actually control, then you don't actually control demand. You're just borrowing it. That fragility didn't show up when demand was easier, but under pressure, it becomes very obvious. Now, a slow referral month suddenly matters, a platform tweak suddenly hurts, and growth feels unpredictable instead of feeling intentional. Meanwhile, something else is happening at the same time. Practices that know their numbers, and I mean really know them, are in a different position. They know what it costs to acquire a client, they know what a client is worth, and they know that they can turn demand on or off when they need to, and that is leverage. This doesn't mean they're doing anything flashy, it just means they've built infrastructure instead of hoping for consistency. So they don't just try ads, they don't guess, they don't wait around and see what happens and hope things improve 3 to 6 months down the road. They build systems that create demand when they need it. And this is the key point. Marketing didn't cause this shift. Marketing is just exposing it now. So it's showing us who already had control and who didn't. In a stable environment, passive models look fine. In a changing environment, only controlled systems hold up. And that is what we're seeing today. And this is also why marketing suddenly feels so unavoidable. It's not because everyone needs to become a marketer now, but because every business needs a way to control demand instead of constantly relying on luck. And that is what the signal is really telling us. The market isn't rewarding noise, it's rewarding leverage. Now, when you zoom out and you look at all three of these signals together, they point at the same underlying truth. Mental health is no longer operating as a service economy, it's operating as a positioning economy. Now, here's what I mean by that. In a service economy, outcomes are mostly determined by availability. So if you're licensed, if you're competent, if you have open slots, demand flows to you. That used to be enough. But in a positioning economy, that's no longer what decides outcomes. Now outcomes are determined by clarity, who you're for, what problem you solve best, and how clearly that is communicated. This is why we're seeing something that feels a little confusing on the surface, where you can have two practices with the same license, the same clinical training, the same years of experience, and one is capped and stressed out and fighting for margin, while the other is a lot more calm, more profitable, and more selective about who they're working with. And that gap isn't about clinical skill, it's about business model clarity. So your positioning determines who finds you, how price sensitive they are, how quickly they decide, and what kind of relationship they expect with your practice. So when positioning is vague, everything feels harder. Marketing costs more, clients shop around, price becomes the main objection. When positioning is clear, the opposite happens. The right people self-select in, the wrong people self-select out, conversations get shorter, and decisions get a lot easier, not because you're better, but because you're clear. And that's really what a positioning economy does. It doesn't reward effort, it rewards more precision. And this is why all three of these signals matter together. Full caseloads with flat income, splitting price sensitivity, and marketing exposing weak models. They're not separate problems, they're symptoms of the same shift. The market is no longer asking, can you provide this service? It's asking, is this built for me? And practices that can answer that clearly are being pulled forward, while the rest are feeling increasing friction. And that is the pattern that is forming. And once you see it this way, a lot of what's been feeling confusing suddenly starts to make sense. So at this point, it's not really about insurance versus private pay anymore. It's about which business models are being squeezed by the market and which ones are being rewarded. So first, I want to walk you through the models that are under the most pressure right now. So let's start with insurance-dependent solo practices. Now, these practices aren't struggling because demand is low. They're hurting because reimbursement rates haven't meaningfully increased in years, while administrative and billing complexity keeps climbing. So you're capped on income by payer rules, not by how many people want your help. So even when demand goes up, your upside doesn't really go up at all. And this creates a very specific experience where you're fully booked, you're busy every week, and yet you still feel stressed and underpaid. Any attempt to earn more means more sessions, more hours, more strain. Insurance didn't kill these practices, it froze them in place while costs continued to rise because it needs these clinicians to deliver services to their clients. The second model getting squeezed is high volume, low price teletherapy, the race to the bottom marketplaces. Now, these models rely on scale to survive, but scale comes with trade-offs. So client churn is high, therapists burn out quickly, and customer acquisition costs keep rising while retention keeps falling. So these businesses only work at massive scale. And even then, margins are thin and trust is fragile. So when acquisition costs rise or clinician supply tightens, the whole model starts to wobble. That pressure is showing up now. The third model under pressure is the undifferentiated group practice. This is the model that says we do anxiety, depression, trauma, couples, teens, EMDR, CBT, mindfulness, everything. And on the surface, that sounds very flexible. When there's no clear why you, marketing sounds identical to everyone else. So your website looks like every other practice, your messaging blends together, and clients can't tell why they should choose you specifically. So what happens? Price sensitivity goes up because when everything sounds the same, price becomes the deciding factor, the same as in any market. Sameness creates pressure. Now let me walk you through the models that are being rewarded. So as I do this, I want you to notice something. None of these models are working because they're flashy. They're working because they're aligned with how the market actually makes decisions. Let's start with private pay, clearly positioned practices. Now these practices aren't selling therapy as a general service. They're selling outcomes to a very specific type of person. They're clear about who they help best, what problem they solve, and why their approach is different. So what's working right now looks a little something like this. They're serving high-functioning professionals. That's people dealing with burnout and nervous system overload, trauma-informed care framed in performance and regulation language, so clear boundaries, premium pricing. Now here's the key point. People aren't price sensitive when they believe, oh, this was built for me. When that belief is there, the conversation completely changes, and clients stop shopping around and they stop comparing, and they actually move forward with confidence. The second category being rewarded is specialized group practices. Now, the important distinction here is this: it's not more clinicians, it's more focus. The practices that win in this category are very clear about what they do and what they don't. So trauma-only practices using EMDR or somatic work, executive mental health, women's nervous system and hormonal health, ADHD for adults with careers. Specialization does a few things at once. It increases close rates, it raises session value, and it improves clinician retention, because when everyone knows who the practice is for, expectations are clear on all sides. So the third model being rewarded is hybrid practices. These businesses don't rely on a single stream. They're not dependent on one type of client or one way of delivering care. Common hybrids look like therapy combined with intensives, therapy combined with groups, therapy combined with education or programs, or concierge style access layered on top of care. This structure reduces pressure, it smooths seasonal swings, it lowers insurance dependency, and it reduces burnout risk for both owners and clinicians. And then we have the quiet separator. So practices that market like real businesses, not aggressively, not noisily, but intentionally. These are the practices that know their numbers, so they track customer acquisition costs. They don't just go off of vibes. They understand audience psychology, and they treat marketing as infrastructure, not a side task. And they build trust before the consultation. So they don't try ads, they build systems. Okay, and that's the common thread across all of these models. They're not necessarily working harder, they're just operating with more control, which means more clarity, and it provides more leverage for them and fewer points of failure. That's really why these models are being rewarded as the market shifts, not because they're better clinicians, but because they're better aligned with how the market now works. Mental health businesses are being sorted into two buckets. We have the squeezed bucket, which is defined by low pricing, high volume, low differentiation, external control, and the practices that are being rewarded, which are defined by clear niches, premium positioning, internal control, outcome-driven messaging. Now, this is where a lot of practice owners misread what's actually happening, and this misread is understandable, but it's also dangerous if you act on it too quickly. When people start to notice this shift, a few very common conclusions show up. Some owners look at all of this and think, insurance is dying, I need to drop panels immediately. Others might think private pay just means charging more and I'll lose clients. Some think I just need better marketing, and some people even think I need more clinicians to spread the load. Now here's the important thing that you need to understand. None of these reactions are irrational. They're just incomplete. The mistake isn't what people want to change. The mistake is how they think that change happens. So dropping insurance panels overnight, it doesn't fix a fragile business model. It just removes a revenue stream before any sort of replacement exists. Charging more without changing your positioning doesn't reduce price sensitivity. It actually increases it. Better marketing doesn't fix unclear messaging. It just amplifies the confusion faster. And hiring more clinicians doesn't reduce pressure if the underlying economics haven't changed at all. It just spreads the strain. What these responses all have in common is this: they're reactive. They assume the solution is a single move instead of a sequence of moves. The practices that are actually winning right now didn't make dramatic decisions, they didn't flip a switch, they didn't gamble their income, and they didn't try to outwork structural problems. They changed the order of operations. So they clarified positioning before raising their prices. They built demand control before removing insurance constraints. They added a growth engine that wasn't governed by insurance rules alongside what already existed, not instead of it. Now, this sequencing is everything, because when you get the sequence wrong, even the right ideas backfire. And when you get the sequence right, change feels controlled instead of risky. This is why this moment in the market is a little bit tricky, because the signals are real, but the correct response isn't urgency, it's actually precision. And once you're able to see that, the conversation really shifts. And the question stops being, what do I need to drop? And it becomes, what do I need to build first? And for most practice owners, that's where things get a little unclear. Not because they're incapable, but because no one ever taught them how to build leverage before making changes. So if this video is resonating, it's probably because you can already feel this shift happening, even if you haven't quite been able to put a name to it yet. So you might not be ready to act, but you're aware that something needs to change, and that's actually the right place where you want to be. If you want to go deeper into this, I put together a free training that walks through why insurance-only models plateau, how private pay growth actually works, and what it looks like to build this without blowing up your practice. The link to that video is in the description below. Go ahead and watch that next. So I hope this gave you some clarity, and I will see you next time.